Hello, ladies and gentlemen, and welcome back. Well, we finally did it. Together, we made it to the 200-day simple moving average, the downward trend line that marked the most important level for 2022, and of course, the all-important gap fill. Now that we've done all of this, what happens next in markets is going to be incredibly important. Many people believe that if the market rallies through this zone, we've entered a new bull market. There are certain key levels that we need to discuss in today's video that will make a big difference whether you trade stocks, commodities, or cryptos. But could this also mark the beginning of a new downtrend as well, and possibly even a crash in markets? We've got the new smart money, dumb money inflows over the last 24 hours. And of course, we need to discuss it all now together. See you soon. Well, welcome back everybody to the Daily Show. Let's begin by discussing some big numbers here. As always, follow at FX Evolution over on Twitter. We share a lot of these charts before the videos and during the sessions, so make sure to do that. Links in the description down below. So we'll begin here with smart money versus dumb money inflows. As we know, if they ever disconnect by too much, we have to start playing with the idea that maybe the bears or the bulls could be coming back in. And while the last 3 trade sessions we've seen dumb money or smaller money inflows increase, at the same time we've seen smarter money fading that rally. Now it makes some sense. Basically the inflation numbers came in flat, which we'll discuss very, very soon. But firstly and foremostly, this is a forward potential indicator of when you need to be a little bit more concerned and a little bit more, let's call it speedy and nimble in markets. We also have another big bit of information, which is the first time in literally 22 years that this has occurred, and that's the world yield curve. It inverted since the first time since the 2000s. So while we've been discussing US 2-year, 10-year, 3-month, 10-year, and all these other yield curves together inverting, it's now the entire world that is inverted. Does that mark some potential real issues in 2023? Well, of course, when the bond market thinks these types of things, it's always going to be important. Let's move over to fear and greed index. We haven't discussed this one in a while because it hasn't really been showing us anything other than just slight fear, neutral, or slight greed. But I think it'll be worthwhile talking about it now that we hit a critical level in markets. So first up, we've got a 57 reading, slight greed. And this has been brought across by realistically 7 fear and greed indicators. Some of these you may be familiar with. Of course, market momentum is certainly an important one. Stock price strength, certainly an important one. But I think the ones that make the most amount of sense at the moment, even though we don't always use them, is the put and call options, where some of the puts have been dropping off a little bit and we've seen an increase in calls. That's good if you're a bear, by the way, in markets. And of course, stock price breadth. This is something that most people look at when it comes to recoveries in markets. And we'll have a special show on the weekend with some big data coming out from some of the sectors in the market. So make sure to subscribe and watch that one. So why is the stock market where it is? It didn't really have a huge reaction off that CPI news. The reason why, it came in pretty much perfectly in line. And yes, it looks like inflation's dropping. Now the market has to make a decision to whether we get what they call a soft landing, or a perfect situation where inflation starts to drop now, which we expect it to do so in 2023, and it drops steadily like it has done so before. If we take a look at the numbers as they came out, you'll notice on the right-hand side here some of the moves. Predominantly, it was pretty much where you would expect. The main concerns have always been and will continue to be food and I think shelter. And shelter didn't exactly drop. So to me, shelter is still one of the main sticking points. And what this led to was a decent move in gold. And I believe that move has to do with 2 things. One, we saw interest rates drop over the last 24 hours. We also saw, though, the chance for potential stagflation in the economy. Remember, shelter and food tend to be the stickiest CPI numbers, the inflation numbers here. And when we take all of them into consideration, you can see down here, food and beverage and shelter. Shelter's not exactly dropping, is it? It's kind of remaining steady as it comes up to, I guess you would say, be more in line with current house prices. And then, of course, food and beverage, while it's dropping, does it continue to do so? Do we have some kind of I don't know, climate issues around the world. We're seeing corn futures and soybean futures still looking a little bit shaky. These are definitely discussion points for 2023. CPI year on year, that's the numbers here. Again, you can see what's dropping or what isn't. Food is really big problem up there in the top, food and beverages. That will continue to be so. And of course, the other one is rents of primary residence, the sticky two. Now, why do we consider these important? Well, consider this chart here. Shelter and food are the two most important sectors, and these will be continued as we know. So let's now look at a few other little bits of information. I actually want to bring this one up first, which is inflation today versus the 1970s. You've probably seen this chart if you've been watching the channel for a while, and you would know that traditionally, which is now down more like in here, traditionally, once this starts to happen, it actually has a fairly good track record at dropping off fairly consistently, and the market's definitely pricing into that. I wouldn't be surprised, though, due to stuff that's going on in China, if we don't get one of these little hiccups at some point in 2023, and I would probably think it comes through over the next couple of reads. So don't be surprised at all for a small hiccup in inflation at some point over the next quarter, and then ideally we will continue to go down. This is not really the story now anymore of 2023. It's going to be how much damage has the Federal Reserve done to the economy as a whole. Let's move over to one of the big stats as well that you might like to know if you're feeling bullish on markets, and that is that if you ever get the trifecta, it really hasn't been wrong. And what the trifecta is it's the Santa Claus rally. Now, remember, there are two types of people that believe rallies are at different points. Yes, we actually did technically get one as of 2023, which was, of course, after Christmas to the first few trading days of the year. Then we have the first 5 trading days of the year, which we already saw were positive. And if we have a positive January return, to be decided, we don't know yet, then with a previous year of negative returns, it tends to be a bullish time. I'm very interested to relive and have a look at this particular data at the end of January. So definitely join us, because this one is going to be one of those data stats that if you actually pull all of the data, you'd be surprised how many times it's been correct in the past. Also, quick reminder, we are giving away a whole bunch of our courses for 2023. It's completely free to enter. Why not consider doing so? If you win the first prize, I'll be chatting to you in February, of course, so that's going to be pretty sweet. FX Evolution, all you need to do, click the link in the description down below or the pinned message, name, email, enter. That's it. We'll draw it next week, and I wish each and every one of you the best of luck. So another data story for 2023, I really can't stress this enough, is to understand that if you're an investor or a medium to long-term kind of player in markets, a lot of the time you really are looking at things like forward PEs and other valuation metrics. Now, it's not to say forward PE is the most important, but do remember it's at least in line with markets, and it's always self-adjusting to markets. So we've seen numbers such as 15 in 2022 being reached right down the lows there for certain stocks. We've also known that in the last couple of crashes, we usually got between kind of 10 and 14, 15. So realistically, anywhere in that zone, it's kind of like, well, is it worth me having a go at it? You've got to make that decision, but I think forward PEs are well worth looking at in 2023. We'll keep you updated here on the channel over that time. What's going on with earnings? Well, it all kicks off as of Friday. Citi, Wells Fargo, Bank of America, and JP Morgan. These are just to name a few, but as we know, we're at critical levels. So depending on how the earnings results start to stack up, I think we're going to find a break here either way for the stock markets, and we'll go through those scenarios very, very soon. Let's move over to what's been happening in money flow in terms of under the hood of the S&P 500. Clean energy, metals, materials, gold, energy. These were the ones that did the best over the last 24 hours. And it was more of a stagflation style play, along with an improvement in all of those growth kind of stocks that have had money flows in them recently. If we look at the last 5 trading days, again, you'll notice it was all about actually Russell 2000 smaller stocks. They had the best return, 16%. That's no joke. And of course, semiconductors also had a big rally. The concern here has to be the squeeze stocks. We'll look at those in a second. So everyone's going to be talking about the VIX. and rightfully so. In 2022, each time we came down to these levels, we saw drops in the market and, of course, rallies in the VIX. We just hit an 18 handle. So now that we've hit the 18 handle, the next couple of days trading are going to be super important. As many of you would know, if you're underneath 20, many people consider it the beginning of a bull market. If you're over 20, people consider it the beginning of a bear market. So we're underneath at the moment, but we're at absolute critical, with absolute critical levels being reached by a whole bunch of other large markets. At the same time as we find ourselves at absolute critical, we have runaway short squeezes. AMC, BBBY, a whole bunch of other stocks that probably have no business being worth anything in particular have squeezes going on right now in the markets. Now, if you're part of these, you always need to know what they are. Remember, you need to realize that you probably want to think about an exit plan on most of these. History will tell you that's what's up. But this is 3 to 4 strong days now. And oftentimes when we've seen some of these rallies, even though this isn't really the poster child for this, if we overlaid the S&P 500, you'll actually notice that a lot of the time when the rallies have come through, it's been consistent with these tops in markets. And if you overlay something like an AMC on top as well, you'll see a very similar situation. We've done this chart before here for these markets. So basically we've shown that when we've had these epic rallies, and of course AMC is not as epic as it used to be, we've topped off in markets. Again, smart money versus dumb money. It's kind of like a proven concept of let's be wary at these levels. Let's move over now to the US 2-year. We saw yields across the board drop. More importantly, in the forward range and in the kind of back end 2024, we'll bring an updated chart to that. But you can see here 2 years made a new low. That's pretty important. Let's take a look at the 10-year as well. And the 10-year got right back down to the lows. Is it enough to say, oh, yes, inflation is gone? It says that we're on the right track. And that's what the market's taking into consideration. There was no real surprise in that report. That's why the market didn't move heavily. However, there were some asset classes that did very well. One of them has to be noted as the bonds. High yield bonds rocketed, but they didn't rocket anywhere near as much as treasuries did. Take a look at treasuries here, up 2% on the session, almost back to their highs. And look, many people are calling this the investment of 2023. I haven't doubted that it's a pretty good period. During deflationary busts, you do tend to find a pretty strong move in treasuries, and so far so good. Obviously, we liked it down here. Right now, it's getting back up into that kind of top range. And I wouldn't be surprised if it does something like this over the next quarter. I wouldn't even be surprised if it goes back up. I am bullish on TLT, but I don't tend to trade it. And the reason why is because these types of bonds, they're more of an investment vehicle to me when the time is right. And again, timing is everything with these, because if you go back over the weekly of the last 20 years, where are we? We're basically at price of the GFC. So you can see that they're an investment vehicle during the right times. And if you get them at the wrong time, it can do brutal damage to you. Let's move over to the DXY. This was the biggest mover, I feel, other than crypto in the last 24 hours. Main reasons, it fell through the trend line. Now, we have still one trading day for the weekly here, but look at that daily. This is the trend line that started all of the rallies in the US dollar. It finally weakened. We had an inkling this may occur basically on this huge shooting star style rejection candle that came through. Does the US dollar actually close low? Next 24 hours will be important for this one. We don't have too much information yet because, as we know, when we go into a 1 hour and things, we can just see it on the low. If you scroll down to a 15-minute, it doesn't show you any real patterns. But if it does reject back up, we've got to talk about it. We will do so on the weekend. At this stage, it looks like, of course, DXY is currently quite weak. I would allow it the next 24 hours to figure out whether it wants to hold lower. Gold was one of the beneficiaries. Stagflation, cutting rates in the future, all of these things started to come through. It hit, I think it actually hit, it hit $1,900 an ounce, and it doesn't show us signs of weakness just yet. So the market's still continuously holding up. Obviously, that 1872, 71 level, very interesting. We did sniff out that this was probably a false one because it didn't make underneath that low. So lucky that that was something we did discuss. And for now, gold is still bullish, but I'm going to mark some levels just in case they occur in the future. First up, 1865. I want to know about that should it happen. I also think that at some stage we're going to create some potential structure. We haven't done so yet. And if we do, then we'll be looking for potential reversals here. I'm still bullish gold, but I do think the storyline is starting to become very crowded. Everyone loves gold at the moment. Maybe we need to hit $2,000 an ounce before there's really big calls coming out. But I'll say one thing. If people start calling 10K gold, usually you know you're close to the end and you've got to be very careful and have a strategy. And that doesn't mean the gold's going to get wrecked. It just means that that last kind of couple of trade sessions, if not last couple of weeks, may get taken off fairly quickly. US oil was another semi-beneficiary here. It ran in and it went past the 77. Now, I think a big reason why it went past the 77 quite easily was this area here. This didn't quite reach that level that we wished to short it off on. It then couldn't break underneath the trend line, and now it's come back into this zone. I've set an alert at 77 itself. If it breaches underneath there in the next 24 hours, then you would have to expect that this market, as in oil, is probably short. So a very key level to be watching. At this stage, we'll see how the weekly ends up, and you can see it here. If we end up getting I think a fairly strong weekly here, and especially if we break through with a daily close above 81, you've got to expect barrels to potentially go all the way back up into the 90s. And although I've been a bearish person on barrels, and I still wish 65, 66, some of the metrics, especially the China reopening play, it does hurt that idea of getting a 65, 66. Look, China reopening's no joke. They're purchasing everything. You can see it. Copper's flying through the roof. Let's just have a quick look at copper. Look at that. Ridiculous movements. Metals are going wild. Everything's picking up based on that stimulation. And what 2023 story probably is going to be is what's happening in China. It goes against kind of what the world's trying to do right now. They're stimulating their economy and printing, basically. And then at the same time, we've got everyone else saying, please don't do that. We don't want to. So it's kind of, this is economic mixture. It's not really good. And it's going to make it very difficult to navigate. That's part of the reason we're talking about that inflation number, as possibly we might get a hiccup caused by the reopening in China. And that's kind of counter logic, but I think it's possible. Let's move over here to Tesla. Still holding up. Next 24 hours expected to remain between 126 and 120 most of the time. So not huge moves in the next 24 hours. Obviously, this 126 is also that previous little resistance. So Tesla is really just in the holding zone. I'd like to see it hold for a little bit longer. I'd even like to see a nice sell-off on it, forcing maybe a really great reversal down here. But we haven't got any of that information yet. So we'll revisit Tesla probably on the weekend video. Apple looking really great for the weekly close. Should it close like this? Obviously 2 rejection wicks and a bullish close. It could mark for further bullish pressure, which we'll talk about soon. And yeah, this is a very important closure here because Apple has managed to just get right on that level of the wick rejection the other day. We know that there's those 2 wick demands, and we also know we're at critical levels for the S&P 500. So if Apple starts to play the game and get bullish again, filling maybe a 143 gap, what does that mean for the S&P 500? Well, it would mean that we break the 22 down trend line. So we'll bring this one back, but at this stage, yeah, it's at just a super critical zone. Nvidia also had a nice move in it, still strong movements here out of semiconductors, and we've seen consumer discretionary versus staples. As we reported on it this week, it is all about risk on at the moment. Consumer discretionary, semiconductors, and tech. Luckily, we picked that out. So they've been some of the better performers during these current day rallies. US 2000, very similar. Look at that. Just absolute blitzing here coming through this. And again, it's this type of trap that you should be looking at. Shooting star followed by a bullish close. What's that tell us about momentum? There was a trap that was set, and then bam, 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 bullish, bullish, bullish into the next couple of sessions. What happens in this next area, though, is going to be important. Of course, the S&P 500 will probably tell us more about that. RK, just to prove the idea that Russell 2000 and smaller caps are doing well. absolutely flying again. Do I like ARK? Probably not as an investment myself, but this is still improving, and it just shows you those hyper stocks have had some of the best sessions in them recently, along with, of course, the short squeezes. So clearly a bit of FOMO is coming back into that market. That's when you want to be, again, a little fearful when you see these types of things. US 100, what's going on there? Nasdaq, pretty strong. Nice breakout at critical. So at that previous supports, becoming potential resistance. We're at the critical. For the Nasdaq, some key levels to watch over the next couple of sessions will be that 2, where it kind of dropped down to, though I think it's actually here. So I'm kind of torn between whether the structure is here or here for the Nasdaq over the next 24 hours, but I think both of those levels are worthwhile watching if you're feeling bearish. If the market does manage to get down past that kind of 11,200, it's going to be significant, and we're at absolute critical zoning right now for this market. So certainly key levels here. You might want to draw something like a fib retracement as well on this. It hasn't got to the super critical, but it's about that 50% right now at these key levels. Let's move over to the SPY. So we know that the S&P 500, pretty strong looking daily candle. We use the SPX for it. This is where we found ourselves. So it's basically the downward trend line that stopped every bull market rally in 2022 has been reached. Now, everyone probably sees this now. Of course, we were possibly one of the first to see it over here, but everyone sees this now, and probably everyone's talking about it. 200-day, we know that has been well respected recently. We also know that the gap fill has happened, so we can remove this. So the 39.95, job done and completed. We still have unfilled gaps here, and we still have unfilled gaps all the way down at like that 35, I think it's like 82 or something like that on the S&P 500. Now, what other gaps do we have that we haven't filled? Looks like we've got one up here, yeah? So there's a huge one that's sitting right around up here at about that 42.83. And hear me out. If we break and close above this area, and especially if we're able to get through the 4100, we have to consider the real possibility that 42.83 is possible. And this hasn't happened yet. We're at critical. We'll talk about that in a second. But 4100-ish, this area here, between 4100 and 4140, critical. If we breach, I believe we go back to 43. And I'll talk about that in another video, and even how this could still instigate a pretty big sell-off. But people will freak out if these levels are taken, especially if that's taken. So keep your mind open to both sides. It's what you have to do as a trader and an investor, and be wary of these style situations. So a lot of people are going to see this level. It's what happens next that's going to be super important. Let's go into the 15-minute chart and understand the action after the CPI numbers. Here we have them. So we basically have the resistance in kind of level. Funnily enough, where's it hit? 39.95. 4,000 exactly on our zone. So I'm pretty happy about that. There were some reactions off that level. I'm sure a few of you were looking towards the short there, which was a good, move down for part of the session. I think the market went down about 1.5% off that. But what's next in store? Well, we know that kind of that 39.40 is going to be critical. We also know that to really bust this thing towards actual bears taking control of it, we're probably going to have to take out 38.70. And you're not going to like hearing that, but that's probably what you're going to have to do. So at this stage, 39.40, breach, pull back, short into 38, kind of 70, 60 area. If that gets taken, then I think we can move towards the 37.50. So this is going to be critical zone. This is going to be critical zone the next 24 hours, the 39.40. And if we're able to do that, then I think we do move down for a little bit longer. Does this make sense to options? We'll talk about that soon. If the market rallies forward, I think we've got to talk about 41.10, 41.40 zone. So if we get a closure above here, we probably move into that area. Still could short off there. If we breach that, as I said, just below 4,300, very likely. And I'll bring that up in a subsequent video as we discuss the three scenarios once we know more. At this stage, I guess we're leaning towards the bear side off this level. It's pretty well known. It should have some kind of reaction off it. That's generally the way we would look at it. Let's refresh now the options moving forward though. And the first one we'll do is the 13th. So we'll look at the 13th, max pain 390. It's currently trading at 7-ish points above that. So again, a little bit of room to come down. Unfortunately, for many traders, they're going to lose all their money in buying puts at the wrong time. Hopefully, most of you are not those. We talk about this a lot. And open interest amounts only 1.16 million. Now, if we scroll to the 20th, which is a 3rd month options expiration, we have 5 million options open. And as we would know, this kind of still plays into the game of what Wall Street wants. Look at some of the strikes that have started opening up. So we've got the 400 strike now with more calls on it than puts. We have the 415 with a lot more calls on it now than there used to be. And we have this kind of interesting 390 zone. So really the market, if I was a market maker, I would like the market to be between 400 and 380 as of the 20th of January. So does this open, considering we're on the top end of that echelon, to push back down into these levels? I think that's probably a very valid scenario. It's something we've played with, and we're trying to thread the needle on both the buy and the sell side here. But obviously this is a technical zone, and somewhere in here is kind of where you're thinking based on options. If it breaks out, of course, all bets are off. You're probably going to say, okay, well, all of a sudden we've got a lot of calls coming in and we move towards this 414, 415 level, at least initially. But yeah, at this stage, the 400, you can see it's quite strong leading into next week, and it would be better for the market to probably go down than up at this stage based on max pain and also where we know the options are. Getting underneath 380, that's going to be hard, and I don't know if it'll be able to do that quite easily. Bitcoin was a massive beneficiary of the last 24 hours. It absolutely flew, and it got all the way through those previous resistances and made it to 19,000. Congrats if you guess you've been holding it long. Do I still think that it could go a lot lower over time? Absolutely. I've said for a while, though, I'd like to see Bitcoin put in its low before the Fed technically does any type of pivoting. It's at a critical level. Again, you can see it just with the bodies of all these previous weekly closes. Significant zone, 19,000. Yeah, it's probably pretty important to see how it acts around here. I'll do a special weekend video maybe on a bit of crypto and thinking about some of the market a bit more in depth. For now, though, if you're feeling short, it's going to be very difficult to be heavily short until you move through that 17,886. So at the moment, it's just kind of in hovering land, and you can see it here on the small time frames. If you want to look at the next 24 hours, again, probably looking at that 18,650. So at the moment, you got like a high, a low, a higher high. Do we get a lower low and then potentially move down to that 17 number? That's the way we'd be looking at Bitcoin. Do remember that it is all about, in the next 24 hours, realistically, the big earnings kickoff. This is banks, financials are coming out. Some of those financials are at really critical highs, JP Morgan, etc. They're at pretty key levels. So if we don't have a good result and it looks like earnings is a bust, the market is not going to like that. And I think that could cause, of course, a short off. If the banks come out really good, maybe we push those pressure points. And you've got to say 41.40, 41.20, all the way up to that 43 are still very open levels should we break through. Quick reminder, if you haven't already entered at FX Evolution, in the description, have a look down there and you can see that we've got a giveaway that we're drawing in less than 4 days now. All you got to do, fill in your name, put in your email address, that's it. And you go in the prize and we'll draw that next week. Thanks so much for watching. Subscribe, smash that like button. We'll see you in the next one. Bye for now.